Understanding trendline breaks is vital as they signify a potential shift in market momentum, indicating a weakening of buying pressure. This phenomenon creates opportunities for traders to leverage bearish movements effectively. The retest of a broken trendline serves as confirmation of a trend change and provides a strategic entry point for short trades, thereby enhancing risk management through tighter stop losses. Furthermore, market psychology is crucial to this strategy. Previous support levels that transform into resistance demonstrate a shift in trader sentiment, subsequently generating additional selling pressure and opportunities for new sellers. In contrast, buyers often mistakenly initiate long positions when the price temporarily surpasses a broken support level, erroneously believing that the trend will persist. Such misunderstandings frequently culminate in significant financial losses. The exhaustion of demand signals a transformation in market dynamics, characterized by an influx of supply above the broken trendline. This alteration results in downward price movement as sellers increasingly take control. A reliable buy signal necessitates both a diagonal trendline break and a horizontal resistance break. This dual breakout implies a robust shift in market dynamics, paving the way for potential upward price movement. The presence of trapped sellers in a bullish market further intensifies buying pressure. As prices escalate, these sellers may be compelled to cover their short positions, thereby fueling additional upward momentum. Moreover, volume analysis is essential for confirming bullish setups. Elevated volume during breakouts signifies strong buying interest, while diminished volume on retests suggests a weakening of selling pressure. This trading strategy exhibits versatility and is applicable across various timeframes. Longer timeframes typically yield more robust signals, enabling traders to accurately identify effective entry points and stop-loss levels. The breach of horizontal resistance denotes a growing strength among buyers, propelling prices into uncharted territory. This development is crucial for discerning market trends and anticipating potential reversals. The retest of the broken trendline marks a critical juncture, determining whether prior support can reclaim its strength or if sellers will maintain dominance. This moment is essential for traders' decision-making processes. Trapped buyers positioned below their entry points generate additional selling pressure, as their stop-loss mechanisms contribute to the downward momentum. This observation underscores the significance of market psychology in trading behavior. Candlestick patterns, such as bearish engulfing patterns or long upper wicks, can further substantiate sell signals during retests. These formations indicate a rejection of higher price levels, thereby reaffirming prevailing market sentiment. The analysis of multiple time frames enhances the credibility of trading signals. Typically, higher time frames provide more substantial indicators of trend changes compared to their lower time frame counterparts. Comprehending complex pullbacks is imperative for identifying trend continuations. Such pullbacks may displace weaker traders, creating avenues to re-enter the prevailing trend after a subsequent retest. Complex pullbacks frequently induce uncertainty among traders, prompting some to liquidate their positions or short the market. This environment presents opportunities for those equipped to comprehend the underlying trend. The significance of volume confirmation during trendline breaks cannot be overstated. Increased trading volume denotes substantial interest from either buyers or sellers, thereby validating the movement within the market. Finally, traders must distinguish between pullbacks and reversals to make informed trading decisions. Context remains paramount, as identical patterns may signify continuation in both upward and downward trends.